let's turn to a discussion of the development of the field of finance. At the turn of the century, finance really developed as its own discipline. The great industrialists, Carnegie, DuPont, Rockefeller, one of the elements that they mastered, which led to the development of these large, huge enterprises, was mergers and acquisitions. They understood how to raise capital and how to deploy that capital to make acquisitions, to build firms that were more valuable than the individual pieces were separately. So finance really began to develop as its own discipline during that period. In the 1930s, we were in a depression, and in that period, finance really evolved to meet the problems that arose at that time. Finance professionals were very concerned with how do we preserve capital? How do we avoid disappearing? How does the firm avoid disappearing? An important element of that is maintaining adequate liquidity, which by that we mean how do we keep enough cash on hand? Remember, this is a period when banks were closing down, so this became a significant concern. Reorganization of financially troubled firms and navigating the bankruptcy process were all important concerns of finance professionals. By the 1950s, finance began to become a little more analytical, a little less descriptive. We were concerned a little less with legal documents per se, or legal methods. At this point, the ideas really began to develop, the economics ideas, the connection to economics of how do we manage financial capital, money, and use that to make acquisitions of real capital, meaning long-term plant and equipment. Likewise, what is the best method and timing for converting real capital back into financial capital? Other issues that were addressed in the 50s were cash management and inventory management. These are disciplines that have become much more sophisticated over time, but there were models developed for how to keep the optimal amount of cash on hand. Obviously, if you keep too much cash around, cash is not an earning asset. You want to invest what cash you can, but you need enough liquidity so that you can make payroll, make purchases, that sort of thing. So there was a lot of discussion of, well, how do we figure out what the optimal amount of cash is, what the optimal amount of inventory to have around is. Walmart has become well known for how quickly they move inventory through the process, how often they're able to sell out basically their stores on an annual basis. And this has led to tremendous profitability and expansion for Walmart. In a sense, Walmart has mastered some of the important finance elements of retailing. Capital structure theory was investigated in the 1950s, and in fact, economists have won Nobel Prizes discussing capital structure theory, which really, in a nutshell, is how much debt should we have, how much equity should we have in a firm. Dividend policy was an important concern in the 1950s, and we still have. We'll still talk about that in this lesson. More recently, while we continue to be very analytic, modern finance has become much more mathematized, and the mathematics of risk and return have become very important. The capital asset pricing model was developed, and this was sort of an early effort to capture how to take into account risk in some sort of systematic, quantifiable way. Two economists won the Nobel Prize for the development of the capital asset pricing model. One of the things that is worth noting is there have been a number of Nobel Prize winners in economics that are concerned with finance. That's an area in which finance differs from other areas within the business curriculum. For example, marketing. There are no Nobel Prizes that have been awarded for marketing. Not that marketing is not important, but it hasn't developed at the same rigor that finance has to this point. There's a little more art that remains in marketing, perhaps. Although there's certainly a lot of science that's been being deployed there as well. Portfolio management was an important concern. How do we put together portfolios of assets? And again, capital structure theory. So I guess the last element that has occurred is there's been a significant development in what we refer to as derivatives. Derivatives are options, futures, forward contracts, swaps. These new financial products that really have been invented are used to hedge against risks that once we could quantify them, it became clear that it would be nice to be able to, if not eliminate the risk, to shift the risk to people who are most able to bear those risks. So these financial products have been developed with that in mind. And another concern, really this developed in the 1970s, because prior to the 1970s, we had very little experience with inflation during the first half of the 20th century, but inflation became an important issue in the 1970s. In the early 1980s, we had double-digit inflation in the U.S. Around the world, there have been economies that have had inflation that has been so destabilizing that really, literally has ruined their economies. So today, even though there's not a great deal of inflation that we see at the moment, there's a great deal of concern about what inflation may be in the future, and financial managers have to take into account the possibility that inflation will reemerge, that in fact inflation itself is a risk. In Japan, over the last decade, they've had exactly the opposite problem, which is referred to as deflation. Now, on the slide that you see here, there's reference made to disinflation. Disinflation is really just sort of an abatement of inflation, but it's not the same as deflation. Deflation occurs when the value of money really begins to rise significantly relative to other assets. So assets become much cheaper over time, not through technological innovation, but just because the value of the money is rising. Deflation creates its own set of problems. So these are all sort of issues that modern finance is concerned with. Cost of capital that we see at the bottom of this particular slide is concerned with what is the cost of raising money. And in its simplest form, that's what's the interest rate. Now, there's also a cost of capital for raising equity. What we pay for equity in the long run is dividends. Does equity have a cost of capital? Well, it doesn't show up on the income statement that the accountants produce, but in fact there is a cost of capital. Certainly shareholders expect to be paid something over time, and moreover the cost of capital is actually higher than the cost of equity capital is actually higher than the cost of debt capital. Debt holders get paid first, they take less risk, therefore they're willing to accept a lower return. Equity holders get paid last, they take more risk, they need a higher return. Unfortunately, what that return isn't in the contract, so we have to infer what it is that shareholders expect from the prices that stocks trade at, that sort of thing. So modern finance is concerned about that issue. What is it that shareholders want? What's the cost of capital that they are expecting, or what's the return on capital that they're expecting?